Fitbit's fourth quarter results are out, and shares are down about 15% in after hours to reflect the weak guidance that management gave for the first quarter. And that guidance missed expectations on the sales, gross margin, and operating margin lines. But management did explain that that was related to the fact that they're rolling out 2 new products, and there's additional marketing cost associated with the new products, and some of the sales will actually not be recognized until the second quarter. So the full year guidance looked okay, generally in line with expectations, although it's a much wider range than they've given in the past. So what we're going to do in this video is we're going to take that additional guidance that management gave us, we're going to plug it into our earnings model, and we're going to kind of walk through some of the changes that we made from our model yesterday and see if that price move makes sense. If you'd like to download this model and follow along, it's on our website, gutenbergresearch.com. You can click the free models tab, scroll down to Fitbit, and click the button to download. So with that, let's get started. And what we're going to do is we're going to basically pull the guidance from some of the highlights that we've already drawn out in the press release. So scroll down to the section where they talk about guidance. And let's skip the full year 2016 and get started with the first quarter, since that's where the bad news is. So they start with revenue. So they're expecting revenue to be between 420 and 440 million. Non-GAAP gross margin well below what we saw in the fourth quarter. So now it's going to go down to 46.5%. And it's interesting that they didn't actually give us a gross margin range. They actually gave us a point. Then adjusted EBITDA is expected to be between 5 and 16 million, and that's going to add back stock-based compensation expense between 18 and 20. Diluted non-GAAP EPS is going to be between 0 and 2 cents. Tax rate of 30%, and diluted share count of 244 million to 246 million. So we've plugged these items into our earnings model, and there's a couple of things that we need to talk about. Oops, this is actually the model from yesterday. Okay, so we've also plugged in the fourth quarter results and full year of 2015. So starting with the revenue line, so management guided between 420 and 440 million. So we got to 430 million, which is the midpoint of that range. And the way we did that is we brought our average selling price down, and we actually brought our average selling price down for the rest of 2016, just based on this fourth quarter. So originally, if you had watched our preview, you would have remembered that we had a $91 average selling price. And since it was so much lower than what our expectation was, we decided it would be smart to reduce our ASP for the rest of 2016. And we also decreased our unit sales. So management said that the Alta device, we wouldn't see a lot of those sales actually recognized in the first quarter. They'd come in the second quarter. So you can see we've got this decrease in the first quarter of units sold, and then we have an increase to sort of bring us back to what our expectations would be for that new product. Now for gross margin, they just guided to that non-GAAP point of 46.5%. And remember that that includes a bit of stock-based compensation. So we've set this equal to the midpoint of their range. So they guided stock-based comp between 18 and 20 million. And the majority of that goes through OPEX, but we do allocate a portion to cost of goods sold. So that gets us to our gross profit on a non-GAAP basis for the first quarter. So now operating expenses. So they did have the Super Bowl ad in the fourth quarter, which was the key to the increase in sales and marketing expenses there. And they did give a little bit of extra guidance on the earnings call if you listened. They did say that they expected sales and marketing expenses to be somewhat consistent with the fourth quarter. So originally that sounded like they meant in whole dollar terms, but in fact another analyst later in the call asked them to clarify, and they said that that was as a percentage of revenue. So the interesting thing is you can't actually get back to their adjusted EBITDA range if you just allocate 42% of revenue in the first quarter, because you're gonna miss it. You're gonna come up with an adjusted EBITDA loss. So we kept it still relatively high. If you look at the total dollar amount, we're looking at 150 million in the first quarter. That's well ahead of any other quarter prior to the fourth quarter of last year. So we're comfortable with this number now. And they did say that year over year it was going to be somewhat consistent. So we're actually allocating a little bit more for the 2016 year to sales and marketing than 2015. Now, we're going to come to the income tax guidance, but the only other item that we have to really get to is their adjusted EBITDA. And they had a relatively wide range here, so didn't put it in a cell, but it's expected to be between 420, or excuse me, it's expected to be between 5 and 16 million. So the midpoint is the 10.5. And so we just hit that midpoint. So now here's the interesting thing here. So if you get back to the adjusted EBITDA, they guided the effective tax rate to 30%. But if you hit the low ends of management's ranges, you're actually going to come up with a pre-tax loss. So we're thinking that that 30% may have been at the high end of the range. So what we did is you can put the 30% tax rate, effective tax rate here. You'll end up with a tax benefit on this line, and your net EPS based on the share count that they gave us would end up being about 4 cents. So rather than giving them a 3-cent benefit for a tax benefit, we actually brought this down to the midpoint of their EPS range of 0 to 2 cents by adjusting the tax rate. So you can see we have a negative tax rate, and that's just basically saying we don't want to give them some huge benefit for this negative income before taxes. And it really depends on where you are in the range. That's going to make up the impact on the tax rate. So all in all, we can get back to the midpoint of management's guidance of just a penny. So obviously well short of expectations for the first quarter. So next, let's take a look at the fiscal 2016 guidance that they gave us. So we'll just scroll up above the first quarter. It's kind of interesting that they put the bad news last. So rather than going first quarter to full year 2016, they went full year 2016 to first quarter. So they're expecting revenue between 2.4 and 2.5 billion. Gross margin, so you see it, they're expecting their full year gross margin to tick back up to 48.5 to 49%. And they did mention on the call that they were saying that the attach rate on the accessories for the new products so far has been higher than what they've seen in the past and higher than their expectations. And that's going to have a benefit on gross margin. Then they give us adjusted EBITDA range of 400 to 480 million and non-GAAP diluted net income per share of 108 to 120. Stock-based comp of 85 to 95 with a tax rate of 30% and share count of 245 to 251 million. So now let's go back to our model. So you can see we hit the midpoint of management's range. We already talked about our ASP and our unit growth rate, which gets us there. We hit the midpoint of the gross margin. So you can see that we are sort of backloading that gross margin. So it's increasing significantly in the second quarter. Then we get a 50 basis point increase and then a 70 basis point increase in the fourth quarter. We'll come back to tax rate again. We've got the midpoint of management stock-based comp expectation, and we're hitting the midpoint of their adjusted EBITDA. And we kind of already talked about what we did with the marketing expenses, which is what's driving that. So now we get to in the share count they gave us, we get to the non-GAAP diluted EPS. So their range is pretty broad. We wanted to hit the midpoint of that range. So again, we used the tax rate to get there. So the tax rate had to be relatively high to bring down our EPS to be at the midpoint of that range. And now we should sort of think about what impact this has on valuation. So you can see our valuation moved to $18. And if you scroll down, you can see we didn't change our multiple. It's the same as what we had prior to the release. And the net cash per share increased a little bit. So they got about 40 cents benefit going from the third quarter to the fourth quarter net cash balance. But a lot of that increase is really just due to the fact that we've now, since we're looking at the next 12-month estimate, we're now counting these 4 quarters rather than these 4 quarters. So you can see this is 94 cents, whereas the next 4 quarters is going to be 114. And just really quick, we should take a look at what we had in our model prior to this release. So this is our model from earlier today. And you can see that the consensus EPS estimate on a non-GAAP basis was actually 113 for full year 2016. So management's new guidance is hitting the midpoint of that range. So what this is saying is if you believe their execution story that the first quarter weakness is really just a result of them ramping the products, spending a lot of money on marketing, and just having that timing issue with the Alta, then overall you can sort of ignore the first quarter and look at the full year as your guidance for what the share valuation should be. Now, on the other hand, if you think execution is going to be a problem, if they're having to basically spend more money in marketing to gain less revenue, then that could be a more dire situation, and in which case the full year fiscal 2016 guidance would have to be trimmed down to like the low end of management's range. So if you'd like to do that, you can run either scenario in here. You can change any of the values. It's better to stick to the cells that we have in blue, just so you don't mess up the equations, but download it from our website and take a look. And if there's anything else you want us to consider in this model, please leave a comments section in the comments, and we will address it in our next update.
Now, before we sign off, I'd like to remind you that our videos, models, and other content are for demonstration purposes only and do not represent investment advice. By viewing, you are deemed to have agreed to our full terms of use, which are available on our website, gutenbergresearch.com. If you're new to our site, please download our free ebook by clicking the thumbnail in the lower left-hand corner of your screen. This goes through our entire approach to financial modeling and equity valuation. We also have a 5-video modeling tutorial series, which you can access by clicking the video in the upper right-hand corner of your screen. And we've included an earnings preview and earnings review video here as well to give you a better idea of what to expect from each type of video. If you're interested in financial modeling, please click the button to subscribe to our YouTube channel. And since we do not always post our review videos to YouTube, please follow us on Facebook using the link in the description section below to stay up to date with all of our model changes. Thanks for watching, and good luck with the rest of earnings season.